All right, everyone. Well, thanks for joining today. My name is Nathan Davis. I'm a partner and chief investment officer here at Aspen Wealth Management. This is our once per quarter market and economic update. A few things that we will go through today is just a review and new starts the year. We get to look back at and not only the fourth quarter of last year, but we get to look at our entire year market returns. It was a pretty good year for markets, which we like. I will say that as a professional investment manager, I don't by any means want to complain when markets are good. We've had two very solid years in a row now. But as I have mentioned before in our updates, it does make things unexciting for preparing these market updates. It almost feels like copy and paste of low volatility, good returns, asset classes are in the green, and so we makes it a little hard to prepare updates. But again, I will not complain about good market returns for any period of time. We still will have a few things that we could find to talk about today. We will spend some time reviewing asset class returns from the fourth quarter in 2024, as I mentioned. We will go over where we stand today, more or less with our economy. Some of those popular measures we like to talk about: inflation, GDP, unemployment, what it might mean for the future. Very well intertwined with those economic expectations is fiscal policy and some of the uncertainty around fiscal policy right now. As you are all aware, we had an election in November. We are changing administrations. Overall, it's possible that it creates some volatility of what to expect. There will be changes. We don't know exactly what those changes will be. We'll talk through kind of base case scenarios for the economy, some of the things that have been proposed so far to date, of what impact those may have on the economy. I will say from an overall summary standpoint, we are not going to focus too much on living and dying by our best guesses for what's going to happen from a policy standpoint. We want to be aware of it. We want to know what might be proposed, what changes it might make. But by no means are we making drastic changes to any of our philosophies today in response to that possible uncertainty. And then lastly, we will talk about implications for investors. We try and tie everything up with, okay, well, what do we do with all this information? We know where the economy stands today. We know what our expectations are for the economy going forward. As investors, what do we do with that information? What's our asset allocation considerations? What are our portfolio management considerations? And so on and so forth. So starting it off with the kind of micro lens of the fourth quarter, the final quarter 2024 it presented a challenging landscape for global markets overall. There was significant divergence across asset classes. U.S. equities showed modest positive returns. Just through the end of the year, did eke out positive returns for the quarter. So I should say through the end of the month. International stocks, emerging markets, real estate all suffered substantial declines for the quarter. Bond markets also faced some headwinds, though certain segments of the bond market offered a degree of stability. Not all parts of the bond market are created equal. There were very much parts of the bond market that did offer some stability, just like we would expect our bonds to do. U.S. stocks, and in this instance, where U.S. stocks are represented by the Russell 3000 index, they delivered a positive return of 2.63% for the quarter. Performance is underscored by just the resilience of our domestic economy. It's supported by solid corporate earnings that we've continued to see. It's supported by consumer spending. As we've talked about in the past, I don't want to ever underestimate the American consumer's propensity to spend. Consumer spending was very much a boon for our economy domestically. And, overall, the U.S. market, it continued to benefit from a strong labor market, easing inflation, all of these things which have allowed the Federal Reserve to adopt a more dovish tone with its monetary policy in terms of what it plans to do with the frequency and the extent of their rate cutting in the future. So in stark contrast to the U.S., international developed markets tracked by the NSCI World ex-US Index, the rest of the world minus the US, posted a sharp decline of 7.43% during the quarter. Europe and Japan faced slower than expected economic growth. All of that was compounded by rising energy prices, geopolitical tensions, and overall the depreciation of several major currencies against the US dollar further exacerbated those losses if you were a dollar-based investor. If you were choosing to invest in those international stocks without hedging the currency risk associated with it, it further added to the potential losses. Emerging markets fared even worse. The MSCI Emerging Markets Index returned negative 8.01%. Weakness in China's economy, particularly the real estate, the manufacturing sectors, weighed heavily on performance. Latin American markets were somewhat insulated by strong commodity prices, but overall they were unable to offset the broader declines that we were seeing in Asia, we were seeing in Eastern Europe. Real estate investments, represented by the S&P Global REIT Index, also experienced a significant downturn, declining 9%, just over 9% for the quarter. Rising interest rates globally continued to diminish the appeal of income-oriented assets. That includes real estate. While tightening credit conditions did lead to a slowdown in property transactions and in development activity. Those mortgage rates, as we see them, where every time we think we're going to get a break, mortgage rates are going to fall. They have really shown the ability, even given a larger economic backdrop, for mortgage rates to hold steady and even see them reverse course and mortgage rates rise a little bit. Overall, the sector's underperformance highlights the sensitivity that real estate markets have for borrowing costs. They're highly leveraged assets. So one of the inputs in calculating our returns is very much going to be those borrowing costs. Very much for the quarter had a negative impact on returns. Fixed income markets were also not spared. U.S. aggregate bond index fell just over 3%. The rise in long-term treasury yields drove down bond prices, particularly for those longer duration instruments. When it comes to the bond market, it kind of starts with the treasury yield curve, and then everything above and beyond it are high quality corporates, are high yield corporates. Everything tends to follow suit. But particularly for those longer duration instruments, were down for the quarter. However, higher yields did provide some cushion for income-focused investors because short-term bonds fared better overall. As I kind of mentioned into the lead up, there are many parts of our fixed income interest rate curve, of our yield curves. Not all are created equal. The short to intermediate term bonds fared better overall than anything that was on the long end, long traditionally being 20 to 30 years. Global bonds, excluding the U.S., tracked by the Bloomberg Global Ag index for inflation currency hedge for the U.S. dollar, managed a modest gain of 0.74%. So it did just eke out some positive returns in the non-U.S. bond market. This performance was primarily driven by a stabilization of central bank policies in Europe, Japan, as well as currency hedging benefits that shielded U.S. investors from foreign exchange volatility. Looking at the quarter as a whole, looking at some of these market performance, some of our key takeaways is that primarily, first and foremost, the divergence across those asset classes, the disparity between U.S. stocks and other asset classes just emphasizes the importance of geographical diversification within portfolios. Not all of these markets are created equal. They operate differently. Sure, there are global factors that are going to impact everything, But these different geographical areas can operate very differently with their markets, with their economy. It leads to a need for global diversification. Rising rates have challenged bonds. Higher yields have pressured fixed income markets. Short-term bonds, currency hedged bonds did provide stability. Another takeaway is emerging markets continue to be very volatile. They do have the potential for outsized gains. That is the purpose for including emerging markets in your portfolio, but they remain very susceptible to macroeconomic and geopolitical risks, leading to increased volatility overall as an asset class for emerging markets. Lastly, real estate and its sensitivity to rates, borrowing costs directly impacted global real estate, underscoring that the sector is very dependent on interest rate trends. And when those interest rate trends are moving in the wrong direction on us, it can very much lead to volatility. Zooming out a little bit from the quarter and looking at the last year, looking at the long term. Probably should have led with this because the year itself was very good, even if the fourth quarter we did see a little bit of a setback. But it just goes to show where in any given day, any given week, month, or quarter, when you pay attention to markets, you pay attention to your account every day, every week, every month, sometimes it can feel like things are going awful. And all you have to do is zoom out a little bit and be like, well, wait a minute. Yeah, all of these global asset classes were down for the quarter, but from January 1st to December 31st, all I have to do is zoom out a little bit. It's a completely different story than what we were just talking about. The entire year of 2024 was characterized by a mix of optimism and caution across global markets. U.S. stocks outperformed international developed, outperformed emerging markets, reflecting the strong economic recovery, the robust corporate earnings, everything we just talked about in the fourth quarter for the U.S. This is, again, the Russell 3000 index that represents the broad total U.S. stock market. Was up 23.81% for the year, January 1st, December 31st. Some of those key drivers, very similar to the past couple of years, include tech sector advancements, the emergence of AI, the enthusiasm for what it will do for corporate P&Ls and corporate balance sheets, and then the resilient consumer spending that we already mentioned. International developed stocks had a positive return for the year. They were up 4.7%, but they did lag overall relative to the U.S. All of this was influenced by slower GDP growth in Europe, and then subdued industrial output in Japan. Emerging markets outperformed developed markets ex-U.S., running 7.5% for the year, still underperformed the U.S., which is a story we've been seeing many, many times for 10 plus years. But emerging markets were, over the course of the year, bolstered by a recovery in China, some strength in the commodity exporting nations, Latin America, like we talked about. Real estate was a mixed bag. U.S. real estate was up, returned to 8% for the year. But global real estate was down 7.83% due to higher interest rates. So when we see our global real estate all combined together, global real estate was up just under 3%. After factoring in that the U.S. real estate was up 8%, the rest of the world, ex-U.S., was down a little bit less than 8%. It all kind of averaged out 2.7% return for global real estate. Some of the things that are not pictured here for the year, but they were still important: commodities. Commodities overall posted moderate gains, 5.38%. Some of the top performers within commodities for the year: coffee was up 78%. Gold was up over 20%. And then, all of that despite losses in natural gas. Natural gas was down 30% for the year. Soybeans, for anyone who cares about that, was down 23% for the year. Overall, commodities did post moderate gains, about 5.4% for the year. Fixed income returns. Fixed income returns were muted overall. U.S. bonds did gain on the year, just 1.25%. What contributes to that is there was positive yields that we received on our bonds now that we have higher rates. We did see some capital depreciation, where even though the Fed was cutting rates, as market forces worked themselves out, and we did see an increase in rates overall, that led to some capital depreciation. So overall, it netted out to 1.25%. The total return for U.S. bonds, rising yields weighed on prices, but we have those higher coupons. And that's what, when we had 2022, which was a really horrific year for both stocks and bonds, one of those like one of one occurrences in historic markets where stocks and bonds both had the terrible year that they did. We did know that the silver lining to 2022 is that we just had to be patient. Yes, we saw the price of our bonds fall, but we knew that the higher yields that came with it would provide us some recovery over time. And 2024 was a great example of that. We continued to see some lagging effects of prices falling, but we are fortunate enough that now we have those higher coupon rates, and those higher coupon rates will just continue to work themselves through the market, have more instruments paying higher coupons as long as we're willing to be patient. Among fixed income sectors, municipal bonds were the weakest. Overall net return for municipal bonds, 1.05%, largely attributed to low demand. The yields weren't quite there. They hadn't risen relative to taxable bonds. And we look at that quite a bit in our portfolio of considering a client's tax return, what kind of income are they making, what marginal tax bracket are they in, and what are those tax equivalent yields of should they be in taxable bonds, should they be in municipals. We've seen that municipal bond yields just haven't quite risen the way everything else has. You have to make a higher and higher income. You need to be in the 35% to 37% plus tax brackets in order to get the net after-tax benefit of being in municipal bonds. All of that has just led to low demand. That's just a supply-demand problem for municipal bonds right now. So summarizing our key insights for the year and beyond, as you can see, 5 years, 10 years, 15 years, 20 years, with the exception of our U.S. bonds not fully recovering from the implications of 2022 and the price depreciation that we saw, which leads to that annualized negative return over 5 years. Given a long enough time frame, markets will provide over 10, 15, 20 years. The majority of our asset classes are returning above and beyond their long-term averages. International developed stocks, emerging market stocks are underperforming their long-term averages over 15, 20 years. But U.S. stock market, particularly for the 15-year time frame, well above its long-term average. And even U.S. bonds for the 15 to 20-year period, in my opinion, only to get better as we let those higher yields work themselves through returns as time goes on, have been looking really good for quite some time. But our key insights, summarizing everything here, U.S. equity market continues to dominate over all periods. Every single one we're looking at here, U.S. equities outperformed other asset classes, demonstrating resilience and the strong growth potential. It does create challenges as well. If we looked at the total global stock market, the U.S. makes up about 65% of it. It's slowly working itself closer to the 70% range of total global stocks living in the United States, domiciling in the United States. The recent years of significant outperformance just make it harder and harder to overcome the recency bias of, man, why would I invest in anything other than the United States? It doesn't mean that you can't overweight yourself with U.S. stocks, but even underperformance for developed countries, emerging markets, they still deserve a part in a portfolio. Being unbiased and trying to overcome that recency bias of, hey, look what it's done lately for me. Of course, that's where I want to be going forward is really challenging, particularly when the numbers look like this. For the themes around emerging markets, for global real estate is very much volatility. Emerging markets have offered higher returns over 20 years relative to developed. But if you look at any given day, month, year within that 20-year period, that is not represented here, our returns don't come without the flip side of risk. There have been significant fluctuations in emerging markets in some of those shorter periods. So you're being compensated with returns above and beyond developed markets, which tend to be less volatile. But emerging markets are outperforming developed, but it's not without the volatility. Global real estate, particularly over the 15-year horizon, has emerged as a really strong performer. Even with the rising rate environment that we've lived in now for 2 going on 3 years, it's been driven by income and recovery in global property markets, getting past the last shakeout of the global financial crisis and the impact that that had on real estate. We're getting further and further away. Uh, Another key takeaway is bond stability. Bonds very much do remain a cornerstone of portfolio diversification, providing consistent returns over a long period of time, even if we've had rate challenges, short-term rate challenges being 22, 23, a little bit of challenges in 2024. Over the long run, it's provided consistent returns. It's provided stability to a portfolio. It's a great diversifier. Speaking of diversification, our last key takeaway, looking at all of these asset classes and their long-term market returns, is again just global diversification. The differences in performance across geographies, it highlights the importance of global diversification if we're managing risks and we're capturing growth in a portfolio. The data emphasizes the value of diversified investment strategy so that we can balance growth with stability over various market cycles. When I look at this and say, I just want to own everything, there's no way to know what is going to be the top performer for the next 20 years. And I'm not going to let the top performer of the last 20 years overly influence my decision for those asset allocation choices. What this says to me is that there's a lot of markets out there. They behave differently. They have different risk and return profiles. And it emphasizes the need for a globally diversified investment strategy. Kind of closing out the backwards with just a reminder of world stock market performance for the year, and some headlines that we saw throughout 2024. So these headlines are not offered up here to explain market returns. Instead, for us, they serve as a reminder that investors should view all of these daily events from a long-term perspective and avoid making investment decisions in the short term solely based on this news. Look, some of these we'll touch on a little bit later, whether it's obviously the long-term impacts of the election, two wildly different parties that were running for office. The economic impacts could very well be different depending on who was elected, even though we've talked about in past quarterly updates. While it feels really hard to believe that two wildly different, philosophically different people wouldn't have wildly different impacts on markets and the economy, history would show us that whoever gets elected into office, the status quo ends up being maintained. It's very unlikely that significant changes to fiscal policy or the economy will come to show for it. But of course, there's plenty of headlines around the election and the lead up to the election. It's starting the year with inflation potentially rising again after rapidly cooling for 2023. We had major tech outages, grounded flights. It hit banks, businesses, markets worldwide. All of these things at the time felt, sometimes they were scary, sometimes they were uncertain, sometimes they were questionable. But when you just look at the blue line for the market levels of global markets throughout the year, even what in the time felt like significant events just look like tiny bumps over the course of the year. Let alone if we look in the top right corner at the long term, the pandemic stands out here. 2007, 2008 stands out here in the long term component of our market since 2000. But all of these things are so quickly forgotten. If it feels important the day of, but we need to remember that the next inflation print, the next Fed meeting, the next earnings release, it can feel so important. Then it passes and it's quickly forgotten, and all anyone cares about is the next one again. And so we don't let all of these headlines, all of these events that very much occur, impact our trading decisions and our asset allocation decisions for the long run. So getting into some of the economic data overall, here we're looking at components of GDP growth. Contributors to real GDP growth, and this is quarter over quarter, seasonally adjusted, and then all annualized. 2024 was another impressive year for the U.S. economy. Real GDP was growing at an above trend pace for a fourth consecutive year now. And to try and understand why economic activity has been so resilient where it's headed, there's a few of these components, of these different components that we can try and analyze to figure out why has our economic activity been so resilient, even when it's felt like there's considerable headwinds. So the chart here offers a closer look at the key drivers behind recent GDP growth. Given that consumption accounts for almost 70% of the U.S. economy, it's no surprise that the health of the economy is closely tied to that of the consumer, supported by impressive gains in household wealth, 20 consecutive months of positive year-over-year real wage gains. Consumer spending has powered the economy forward, contributing 2.4 percentage points to the 2.8% increase in real GDP in the third quarter. These data tend to have a more extreme lag. So this is the third quarter of 2024, so most recent data, most recent verified data. Other segments also performed well. So despite higher borrowing costs, business investment has been buoyed by strong corporate balance sheets and fiscal support. Government spending has continued to look solid. Home building has remained subdued. That was a little bit of a detractor for GDP. As we discussed previously, that's largely due to elevated mortgage rates. But overall, the combination of a strong dollar, sluggish global economic activity, that all has weighed on the U.S. trade balance. U.S. trade balance not being a large contributor to GDP either. Policy uncertainty is very much casting a fog on the economic outlook for 2025. We always talk about what the expectations are, what could possibly happen. I like being aware of forecasts and, hey, what do I need to look for in the economy? In any given year, I don't put a lot of faith into it. And I would say that this year it's probably even less so. There's so much uncertainty. There's so many paths that we can go down. But that policy uncertainty is very much complicating things from an economic outlook standpoint. What's being proposed, if there's severe restrictions on immigration, if there's aggressive tariff policies, should the incoming administration implement these, it could boost inflation. It could move inflation the wrong way from the progress that has been made. And if the Tax Cuts and Jobs Act, which there are many components that are very important to our clients, that we've been keeping an eye on for quite some time, if set to sunset at the end of 2025, if it will continue to be extended, there's very much components of the Tax Cuts and Jobs Act as well, that if it's fully extended, it could boost inflation. If all of that is supplemented by further proposed extensive tax cuts that were promised on the campaign trail. So especially in this year one, while we're getting an idea of what policy may be, there is the potential for impacts on inflation. Now, on the flip side, that none of these policies appear to kind of portend an immediate recession as activity and interest rate sensitive sectors normalize and consumer spending settles at a more moderate pace. By all accounts, 2025 is shaping up to be another year of expansion, likely at a trend-like pace for the U.S. economy, kind of getting back to normal, getting back to trend of a very average year of growth. Uncertainty, absolutely, it's there. We'll be keeping an eye on what sort of policies are being enacted. But all things considered, economic growth is still looking good. Turning over to unemployment, civilian unemployment rate, year-over-year wage growth, and this is private production, non-supervisory workers, seasonally adjusted. All the details on what we're looking at here. After rising during the first half of 2024, unemployment rate has stabilized. We're now at 4.2% as of November. And really, I mean, unemployment is meaningfully above its cycle low of 3.4%, which was set back in April of 2023. I mean, that said, yes, going from 3.4 to 4.2 in the micro seems like quite an increase. 4.2% is still lower than almost 88% of the time over the past 50 years. And so we can see here with our average rate being about 6.2% for unemployment and 50-year average, we are well below. Wage growth, we are on the high. I'm sorry, we are online as well. 3.9% 50-year average, 3.9% as of November 2024. In 2025, looking forward, steady economic growth, what we just talked about for all of our components of GDP. If we continue to see that steady economic growth, it should support continued job gains. It should help reduce the risk of any further meaningful rise in unemployment. And in fact, should the labor force growth slow, so like the overall force of who's available for work, if that labor force growth were to slow due to something like restrictive immigration policies, unemployment might even drift lower over the course of the year. So with stable unemployment, wage growth should stabilize as well. Loosening labor market slack over the past year has led to a moderation in wage growth. Wage growth peaked 7% in March of 2022 and has continued to slow back as unemployment has slowed back post-pandemic, as inflation has slowed back post-pandemic. And as we said, they're now at 3.9% in November, right at the 50-year average. Last thing here, while slower immigration would likely put upwards pressure on wage growth, if we have fewer workers, the workers that we do have here willing to work would likely demand higher wages. If we do sustain the strong productivity gains that we've seen, we could very likely get higher wage growth without the associated pass-through to higher inflation as well. The other side of the calculation for our overall GDP is the workers that we have and how productive are each of those workers. It's like people really like AI. You have all the same amount of workers who can do way more with their productivity gains. Something like that could possibly have everyone making more money and not negatively impact inflation by making everything more expensive to offset it. Speaking of inflation, so looking at our inflation components, what we have here is the contributors to headline CPI inflation. This is year over year percentage, and it's not seasonally adjusted. Inflation made meaningful progress towards the Fed Reserve's 2% target in 2024, which is what allowed the Fed to finally kick off its rate cutting cycle. That said, the downward momentum waned a little bit in the fourth quarter, which is sparking fears that progress on inflation has stalled. Inflation has gotten as low as we can get it. And indeed, overall, the headline CPI rose 2.7% year over year in November, compared to 2.4% just 2 months prior in September. And then just recently, with the most up-to-date inflation print we had from December, was actually a slight increase again to 2.9% in December. However, those recent gains are largely due to what are called base effects, kind of lag effects through the economy, or things that were already built in that we were expecting to see from an inflation perspective. And it's little evidence to show that price pressures are building. It's more price pressures that we were expecting. Inflation should continue to resume its downward march in 2025, all else held constant. For much of last year, core goods prices had been a steady source of deflation as supply chains remained well managed. Even with those elevated geopolitical tensions, supply chains did not suffer. continue to be healthy after the issues that we had with supply chains in 2020 and 21 that had a number of years of lag effect built in. In recent months, some of those prices have started to move higher on a sequential basis, and the largest contributor to that, as we can see here, is vehicle prices continuing to rise again. Looking at the base effects for what we could expect going forward, auto inventory to sales ratios have trended higher off of those post-pandemic lows. And what that suggests is that some of the pressure here should fade. We're seeing it today, but it's being projected out that some of those price pressures should start to see some relief. On the more volatile components, everyone always notices lower gasoline prices, weight on energy prices. Food inflation has remained mild. Moving forward, sluggish global demand does seem to limit the likelihood of a surge in either one of those categories for energy prices, for food. And, to kind of summarize it back to the key drivers of inflation, shelter, auto insurance. Shelter inflation accounts for over a third of the CPI basket, and we're looking at the kind of marginal contributions to our inflation components. Shelter inflation accounts for over a third of the CPI basket and has held stubbornly above the pre-pandemic trend. That said, the real-time measure of market rent does point to more normal levels of shelter inflation ahead. Auto insurance, which is a consistent hotspot of inflation, did ease slightly in November. Even with the ease in November, it's still rising by 13% year over year. Fortunately, as the rollover in vehicle prices speeds through the data, like we just talked about, of maybe there being some relief in sight for vehicle prices, the rise in auto insurance as well should trend lower going forward. We got to let the auto prices themselves normalize and feed through the data, and then a lag effect of that is hopefully seeing some relief in the auto insurance side of inflation too. Overall, inflation by all estimates should continue to ease in 2025. Price gains in shelter and auto insurance remain elevated, that make these numbers skew a little higher than we or the Federal Reserve would like to see. And although the real-time data continues to point to easing price pressures ahead, it appears there's relief in sight. However, as we just talked about with some of the uncertainty around policy, and will there be significant fiscal policy or will there not? Some of those policies discussed, should they be implemented as they've been communicated to this point, which does seem very unlikely. I don't know, Congress doesn't compromise a whole lot these days, but generally if something is being passed, if there's any policies being enacted, it's rarely as it was initially communicated. But as they've been initially communicated, we could see our progress on inflation reverse course, at least temporarily. So a lot of uncertainty there. All else held constant, inflation looks like it should be good, but all else is rarely held constant. So it's just something we need to keep an eye on. So back to the policies and the policies that may have an impact on inflation. Tariffs. We've been hearing quite a bit about tariffs lately. The average, what we're looking at here is the average tariff rate on U.S. goods that were imported for consumption. And this is the collected duties collected versus the value of total goods on imports. So over time, economic globalization has led to increasingly relaxed trade policies. The average tariff rate on U.S. good imports has steadily fallen since the 1930s. However, geopolitical tensions, supply chain issues from COVID, it has prompted a reevaluation of open trade policies, with promises to protect American businesses, address unfair trade practices. Tariffs kind of sit at the center of the Trump administration's policy agenda. What this slide helps us with is to put the recent tariff proposals as they've been communicated into context. Assuming a 20% universal tariff and an additional tariff specifically on Chinese imports of at least 60%, the Tax Foundation has run calculations that would suggest the average tariff rate on US imports could rise to almost 17.7% in 2025, up from 2.4% in 2023. Admittedly, U.S. trade policy remains highly uncertain. It is unclear whether these tariff policies will be implemented as proposed. It's unclear whether they will be implemented permanently or if they'll be used as a negotiation tool. Regardless, tariffs are likely to rise under the incoming administration, with a particular focus on China and goods made in China. Beyond discouraging imports, tariffs can have negative unintended consequences. So if enacted as stated, tariffs could lead to higher inflation. They can trigger retaliation by foreign countries, foreign economies, and it could reduce the demand for U.S. exports. Overall, aggressive tariffs would add even more uncertainty to the already foggy economic outlook that we discussed. And it would create complications for the Federal Reserve in determining their path forward. So when we talk about policies that can have a wide range of outcomes for the U.S., for our economy, and then for a lot of our metrics that people care about, like inflation, unemployment, wage growth, and all those things, tariffs sits pretty near the top of. We will be monitoring the situation to see how real life plays out. All right. So among other expansionary fiscal policies, the Trump administration has also expressed its intent to fully extend the Tax Cuts and Jobs Act, like we talked about, that was supposed to sunset at the end of 2025. So what that would include is to further reduce the corporate tax rate. At this time, it's been proposed or communicated as a dramatic cut to costs. In determining, for the rest of us, in determining whether these policy proposals are feasible, that could impact the fiscal health of the U.S., the charts we have here should be useful. And there's a lot going on here. I try to limit the lots of stuff going on one slide for you, but these are all technically pretty intertwined. So on the left, it shows our CBO estimates for government spending and how that spending will be financed in fiscal year 2025. To reach its cost-cutting goals, the incoming administration may have to make difficult decisions because, to be fair, for policies that have been communicated, any talk of tariffs, any talk of extending tax cuts and Jobs Act and reducing corporate tax rate has not been without its offsetting communication and discussion of reducing government costs, government waste, everything that should help balance the budget. But to reach cost-cutting goals, incoming administration may have to make difficult decisions because the non-defense discretionary spending accounts for just 12% of the government's overall budget, meaning that even if they were able to successfully slash all non-defense discretionary spending, the next place they would have to go to help balance our budget would be explore spending cuts on defense. It would have to include exploring cuts on entitlements. And so it's challenging. At least there's communications and review of where's the government spending its money, where can we make impactful changes. But even if we are running quite a deficit, there's not a lot of apparent waste and low-hanging fruit. They'll definitely have quite a job ahead of them. The administration has also expressed its intent to use tariff revenues to offset the extension of the Tax Cuts and Jobs Act. But as we discussed, tariffs are only a sliver of current government revenues. Even if we see a large jump from the 2.3% to the almost 18%, It's really just a small amount of current government revenues, and that would likely remain the case, even if the tariff policies are implemented. Moreover, higher tariffs, if it were to invite retaliatory tariffs, it could slow the economy. That could reduce revenues from other areas of income on taxation. So what we're looking at on the right-hand side, we explore the outlook for the deficit, and then, of course, can't talk about the deficit without talking about the federal debt as well. And so with no revenue or spending offsets, the Tax Cuts and Job Act is likely to amount to significant stimulus and add to deficits. Every year, the federal deficit gets added to overall debt, which we show on the bottom right. And according to the CBO, federal debt is expected to climb to nearly 120% of GDP by 2034, excluding the impacts of a Tax Cuts and Job Act extension. If we included the impacts of the Tax Cuts and Job Act extension, it would boost to nearly 130%, federal debt being 130% of GDP. And this is all up from 98.2% federal debt to GDP in fiscal year 2024. Other sources, knowing that a lot of times this research, this data can be politically motivated, of course. The Committee for a Responsible Federal Budget believes that a full implementation of President Trump's proposals could boost the debt to a whopping 143% of GDP by 2035. Since the Tax Cuts and Job Act extension and any additional provisions will need to be passed through the once-a-year budget reconciliation process, they're unlikely to go into effect until early 2026. After that, expansionary fiscal policy would not only boost deficits, it could also act as a long-term source of inflationary pressure. So when we talk about the positives we've had with GDP, with inflation, with unemployment, we've talked for a long time about how can you possibly continue to operate at a deficit and continue to let your national debt just expand seemingly without control. Both sides of the aisle have been very comfortable with allowing our federal net debt, those accumulated deficits, to expand. You can see on the bottom right, I mean, it bottomed in 2004 and has been up and to the right since. These are some of the things that we're going to want to be mindful of from a fiscal policy perspective to see how it flows through to the rest of the economic measures that we care about. Last couple things on Fed and interest rates, and then we'll do one more discussion point on the S&P 500. But tying all this back to Fed funds rate expectations and then market expectations. So this is, what does the Fed think that they're going to lower their rates to? What do market participants price in is what the Fed is going to do with their rates? And it's always very funny to me how different they are. The Fed, who sets their own rate, thinks it's going to be one thing, and the market kind of disagrees. But with inflation trending lower and the labor market softening, the Federal Reserve is attentive to both sides and has a dual mandate of managing unemployment, managing inflation. That they, in 2024, cut interest rates by 100 basis points, by 1%. In 2025, the committee certainly has a preference for continuing to ease policy, continuing to reduce rates, until it reaches what it calls a neutral stance. As of right now, they've been forecasting about 3% as the long run neutral rate. However, fiscal stimulus, in addition to tariff and immigration policies and all that, have passed. It could make the Fed's job difficult. They could have to follow a different path in order to get to their ultimate goal. At its final meeting of the year, Federal Reserve voted to cut rates by 25 basis points, by 0.25%, and it reduced the federal funds rate into a range of 4.25 to 4.5%. That move was largely expected, and particularly in markets in that day. It was a little bit of a volatile day around the presentation of the FOMC minutes, but the cut itself was largely expected. What investors found themselves, more focused on was the press conference thereafter, and the Fed's latest set of economic projections, which is them forecasting to market participants what they think that the next year or two, and then in the long run would look like. In his comments, Chair Powell noted that he's optimistic about the health of the economy and that downside risks to the labor market have largely diminished. He also noted that inflation, while still moving in the right direction, has been hotter than expected in recent months. He acknowledged that we did see a stall in our falling inflation rates, and we've seen a slight comeback, as I said, up now to 2.9% as of December. All of these views were reflected in what they call their summary of economic projections, their SEP. And that showed a higher growth forecast and a lower unemployment forecast for 2025, what the Federal Reserve thinks economically is going to happen in 2025. Along with that, they also included a higher inflation forecast for 2025 and 2026. With solid economic activity and increased inflation uncertainty, the committee penciled in just 2 rate cut expectations for 2025 versus when they met in September and they had their summary of economic projections in September. At that point in time, they were projecting 4 rate cuts. So, so an acknowledgement that the economy may be less interest rate sensitive, that they've now set their neutral federal funds rate. It's ticked up a little higher and it's now at 3%, as I mentioned. So today, what does that mean for us today? Today, market expectations remain more hawkish. The market itself, as represented by the light blue line here on the far right of our chart, the market believes that the path for interest rates will stay higher than the Fed themselves have been forecasting. And that's highlighting investors' fear that inflation will persist, that they won't reach the 2% target that they've set for themselves, and therefore will have to keep rates higher. And in all of this, that might force the Fed to consider a slower pace of policy normalization. They may have to pause altogether, and they have to stop the rate cuts altogether. So where we think that policy could shake out, as with most things in life, will probably somewhere in the middle. It will likely still be a gradual policy easing towards the path and the target that they have set. The Fed very well might not be able to systematically and predictably cut rates the way that they've provided in their own forecasts. But it's shaking up with the exception of possible significant changes due to fiscal policy. Of real life path for rates will fall somewhere in between what the Fed themselves think is going to occur and what market participants think. And market participants right now are a little bit more negative on inflation and therefore negative on the economy. So last thing, just closing out with some S&P 500 valuation summaries. We're looking at our forward price to earnings ratio for the S&P 500. There's the price that the stock trades at today, divided by the forward expectations for earnings of those companies. And at 22 times earnings, meaning that on average, the companies that are included, stocks that are included in the S&P 500, when you buy the S&P 500, you buy those companies at a multiple, at a price that is 22 times their forward earnings expectations. At over 22 times, the S&P 500's next 12-month price to earnings ratio is close to the dot-com bubble peak. There are other valuation metrics. This isn't the only one. There's price to book, there's price to cash flow. Those are elevated as well. While this doesn't tell us much about short-term returns, what's going to happen in the next year, I would say what's going to happen in the next even like 3 years and less. History does show that high valuations are correlated to lower long-term returns. If you pay more and more and more and higher multiples for something, it gets harder and harder to earn the return to justify that multiple over time. All the pieces that need to fall in place in order to justify that high price that you paid for it gets harder and harder to hurdle. And so, the high valuations are correlated to lower long-term returns. Mega cap tech stocks are getting a lot of the blame for this. the 10 largest stocks have a forward price to earnings ratio of over 30. That is roughly 150% of the long-term average. When we looked back in the first 2 to 3 slides, hey, what have returns been over the last year, over the last 3 to 5? Very much these same 10 stocks have provided a large part of our returns, thanks to them for the last five years in particular. But those top 10 stocks now constitute almost 40% of the market cap of the S&P 500. So valuations for the remaining stocks, the S&P 500, it's still all very large companies. The other 490 companies or so, they have a forward price to earnings ratio that are under 120% of the long-term average. So we want to be very mindful of value, of what are our expectations for returns in the long run? What are we paying today in order to achieve that return? And we want to make sure that we are being selective. We want to participate in the entire market. We want to be globally diversified. There are, with few exceptions, we want to invest in everything that's available in the marketplace. But when there's value to be had, there's lower prices that we can pay for the same estimates of forward earnings. We want to be mindful of it for sure. There are a lot of publicly traded stocks in the US and then the rest of the world that are not the 10 largest stocks on earth. And we will very much be, hunting those as a good place for less appreciated opportunities. Though elevated index level valuations might give investors pause, dispersion suggests that there are opportunities underneath the hood, as we talked about. The difference in valuations between the 100 most expensive stocks and the 100 least expensive stocks is currently wider than it has been 90% of the time over the last 28 years. Just because something is the cheapest doesn't mean it's the best thing to buy. That's for example's sake. Just because it's the least expensive doesn't mean it's going to earn you more in the long run. But there is a wide difference between the 100 most expensive and the 100 least expensive stocks in terms of what investors are willing to pay for a share of those future earnings. So, odds are there are a lot of stocks out there that have price tags that are too high. There are a lot of stocks out there with price tags that are too low. While this could cause elevated volatility at the overall index level, it should also create opportunities for, active asset allocators, especially as earnings breadth increases. We want to own the total stock market, but we also want to separately own growth. We want to separately own value. We want to separately own our small cap and our mid cap to give us more direct exposure to more asset classes, being broadly diversified, and being able to participate in all of the differences that we see across all of the subsets of the market. So as always, we will close it out with our implications for investors. First and foremost, we just want to avoid common mistakes. We want to win by not losing. We don't want to try to time the market. We don't want to focus on the headlines. And we don't want to find ourselves making long-term solutions to short-term problems. If you think the market's at an all-time high and you sell and you're wrong, that's a market timing mistake. If the stock market is down, you think it's going to continue to go down and it's going to be down forever and you sell and now you don't know how to get back in. That's a long-term solution. Selling is a long-term solution to a short-term problem, which is short-term market volatility. If we have a systematic approach to our investments, if we have an investment policy statement, we should be able to avoid all of those common mistakes. We will maintain a systematic approach. So all-time highs or near all-time highs are no reason to change our philosophy. They're no reason to not invest. And then we are also going to allocate our portfolio on the known, not the expected. As we said, there could be such a wide divergence of what happens to our economy, what happens to inflation, what happens to our stock market based off of the policy changes that have been communicated. But we are not in a rush to make changes to our portfolio based off of those expectations of what might happen and what percent that this policy may pass or may not, and we need to allocate our portfolio accordingly. We want to allocate on what we know today, not on what we expect to happen in the future. And then lastly, we want to have a plan for cash. So be intentional with your allocation to cash and cash plus, which are like cash money market, are a very appropriate, very best place to be for short-term obligations. For major expenses that are occurring in the next year, in the next 2 years, there's no place better to be than high yield savings than money markets. But if we are hoarding cash and our allocation are above and beyond what we need for explicitly covering future obligations, um, we really want to consider short to midterm bonds as an alternative to those outsized cash positions. The yields are more attractive. They're yields that you will be able to collect for longer as the yield curve normalizes and short-term rates fall. And it's avoiding the volatility that we're seeing on the very long end of the curve, the 20 to 30-year treasuries, for example. Have a plan for your cash. It's great for explicit expenses you have in the next year or two. If it's not an expense you have coming up, consider the short to midterm bonds, that 2 to 5 year part of the yield curve as an alternative for your cash. Well, that's it for today. Thanks so much for joining us. I always appreciate when you come. Please provide feedback if you have any questions you can think of. Everything that we discuss here is so broad, it's so generic, but all of these things very much matter to you as individuals. Everyone is unique on what impacts them, what impacts their financial plan. Please don't hesitate to reach out and let us know if you have any questions, anything about your specific circumstances. That is what we are here for. We're here to help. So thank you everyone for attending, and hope everyone has a great day.